All right, this is a complicated topic, but I've been using anchored volume weighted average prices for a while now, a couple of weeks now, and it's been very effective in addition to the rest of my technical analysis using algo lines, relative volume, price action, relative strength, relative weakness, etc. And this is how I'm using it. So first, this line right through here is a volume weighted average price. So all it really does is just calculate where the majority of like buying and selling kind of happened. And what the average price at that happened was. So the way that you can simply use this line is anybody over this line essentially means buyers are in control. Anything below this means sellers in control. Or the average bull is in profits above this orange line. The average bear is in profits below this line. And it's very useful. We use it every single day on SPY and on stocks, etc. We don't buy stocks that are below this line. We don't sell stocks that are above that line. It's very simple. The problem with this is that institutional investors are the ones that are moving the markets, right? They're not necessarily using these lines through here. They might be using it intraday a little bit as a guide, etc. But for the most part, they're buying and selling programs, which are the things that are really moving the markets, are using different volume weighted average prices. Or so this guy says right through here. So this book is called Anchored VWAP by Brian Shannon, and I highly recommend that you read this book. It's a pretty quick read, and it's an awesome read. But essentially what he touts is that when an institutional buyer or investor has to accumulate a position in a company, the size they use is so large that they can't just throw it all down there because let's say they want to buy 500,000 shares of Moderna. If they do that, the price is going to jump right up to there because there's just not enough liquidity to fill 500,000 shares. So they'll keep having to raise the bid all the way up to there, and then they get a terrible price. So what they do is they split it into smaller orders, a whole bunch of tiny little child orders of 100 or 200 shares, and they try to trickle in over the period of a day or an hour or weeks or years or whatever. They're all over the place. It's all fractal. And they try to accumulate that order over time at the best possible price. So if they were using this volume weighted average price through here, they would try to get as much of their shares as possible at this price. Obviously this goes up, goes down, etc. But the closer they get to that, the better. He states that even some of these institutional investors will get bonuses, etc., based on how well they filled an order at volume weighted average price. And investors even like Warren Buffett are using this. This is just the standard fare for how this is used. I believe a company called Citadel, which is a brokerage, says they do about 30% of all the trading, and they fulfill about 30% of all the orders, and they say the majority of them are all done by automated algorithmic programs that divide up the order into these tiny little purchases using volume weighted average price. So if our job is to find the institutional investing activity, where do we actually create these lines? Because at the start of the day isn't necessarily where these guys are doing it. So you got to remember, these guys have PhDs out the wazoo. They have multi-million-dollar analysis computers. They have access to more information than we need. So they know exactly the best predictions for where these companies are going to end up. You're not going to be able to figure out more than them. So all you need to do is figure out what they're doing. You don't need to know what they know. You just need to figure out what they're doing. In the same way that we use relative strength, this is another tool that you can layer on top of that, and it can help you find hidden lines of support and resistance. So check this out. So here's Google. Now, an institution's projection for this stock would change based on new information coming out that they didn't know before. So anytime you see something significant, like significant reversals or significant buying and selling activity or significant news events, that's where you can put an volume or an anchored volume weighted average price. So this is earnings right here. We can throw one on through there. But if you look at this big giant line of support right through here, you can also put them at places where there is significant volume, like this area right through here, which is a rebound off of a trend line that's a significant trend line. And then you can see now that Google, after earnings, is in compression, compressing back and forth between these two lines. So if you zoom in to a day like yesterday, Google at the first half of the day had excellent relative strength. It was just ripping. A couple people bought this stock. The problem is that as soon as it reached this line through here, these automated programs realize that they reached the best price. And so now they're going to wait for things to sell off a bit and then come back to it so they can get it again. Because if they just keep buying, they're going to pay too much according to what they think. So that's why you saw relative strength coming all the way up to that earnings AVWAP. And then all of a sudden, the relative strength just shut off and Google just floated with the rest of the market. You can even take these lines and you can make them fractal. So they work on almost every single time frame, but obviously the smaller the time frame, the less effective they are in terms of being rock solid. The larger the time frame and the more significant the event that they're anchored to, the stronger they are. So you can take this rejection through here and you can just put one on there and you can see how Google just followed that line all the way down. This has been really, really useful for me to find all of these hidden lines or these hidden places where institutional activity might change, where reversals might happen, or things might really start pouring on, or where there's support and resistance at places where you don't necessarily see it. So for example, you could have a weekly at the money through here, which I do. It's a 129 short, 128 long. And as soon as you see this right through here, you could sell the short put, and then you could just wait until it goes back above again. And if it goes back above and forms support, then you can short another put, or you can just ride the long put down to support again and see if it hits through there. Things like that are very useful. Or if you're looking for an entry on a stock, let's say something like Lilly, which is at all-time highs, you can see the earnings right through here. So we know we can use that as a support line. So we know that it might pull back all the way to there. You could use the algo line through there. But more importantly, if you're looking at your entry, you probably want to wait until support is formed above this line. Now these are, these might change, and this is very, very discretionary. So you run the risk of making all these imaginary lines all over the place. But if you can find these significant events, these news moments, these areas where things change the story on the stock, you can actually start to uncover more clues of where the institutional buying and selling is happening. It works very effective on the D1 chart, but the better you get at it, I firmly believe that you can probably use it intraday as well, and you can start looking at SPY and doing things like this as well. You can see the peak from there, the selling sold off right there, and we never got above that line through there, and that's just the regular from the start of the day. But more importantly, you might be wondering, well, wait, we broke VWAP through here, so why did it reject up there? Well, that line stretches all the way back to this shock factor where we bounced off a different anchor VWAP, gapped down against where everybody thought we were going to be out of this, and then we recommenced the downtrend on SPY. So this stuff is everywhere, and it's very, very exciting. But you have to learn how to use it correctly. Otherwise, you're going to make a mess of stuff around here. All right, so that video is long enough. That's Anchor VWAP. I'll probably throw another couple videos on there on like the general rule set that I use to find these things and also to use them in terms of when they're safe as support or safe as resistance.